Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. Well, when the first estimate of second quarter GDP was announced, we learned that the U.S. economy slowed from a growth rate of 3.1% in the first quarter to 2.1% in the second quarter. But within that report, the strongest sector was consumer spending was jumped by over 4%. So what really held the U.S. economy together in the second quarter was a positive, confident consumer willing to go out and spend a chunk of their money in savings. As you look at this chart, you can see after other big spikes that have occurred over the last couple of years, they have typically been followed by a pullback, which only makes sense. In the first quarter, consumer spending dropped after a pretty decent third and fourth quarter of last year. I think the same thing is just inherently likely as consumers pull back a little bit after a great second quarter of spending. But I think there's other things that we have to take note of that potentially imply that the coming decline and slowing in consumer spending could be more pronounced and longer lasting. When the employment report was released on August 2nd, showing 164,000 jobs, it was in line with expectations. Earnings growth rose 3.2%, up from 3.1% in the prior month. However, underneath the surface, there are some things that suggest that we're going to see a slowdown in the labor market in coming months. So as most people focused on the headline, 164,000 jobs, unemployment rate still near a 50-year low, wage growth up, we'll look and see why I think there's some seeds for a slowing coming. If you look at the 6-month moving average of job growth, we can see that it has slowed to about the slowest rate since about 2012-13. And the trajectory has been pretty pronounced in terms of slowing. Average hourly wages versus weekly wage point to a very interesting concept. We can see averagely hour wages rose 3.2%. Well, how can that be while weekly wages actually fell from prior months, or the rate of growth, I should say? All right, well, here's what's going on. When the economy starts to slow, employers look to cut back. And one of the first things they do cut back is overtime hours. That makes sense. And we're seeing that show up in the data. In the last 6 months, we've seen overtime hours drop significantly, and the rate of change is actually negative. So even though wages grew from 3.1 to 3.2, a lot of workers, they're not getting the overtime pay they were getting previously. If we look at the annual labor market changes, again, you can see hourly wages at 3.2, non-farm payrolls are about 1.5% has been the annual growth rate over the last 12 months. You can see that it has slowed markedly after the nice spurt during 2018. Total hours worked, though, show that people are still employed, but they're getting a couple hours per week less. So even though wages are up from 3.1 to 3.2, if you're working a couple hours less, your wage growth is going to suffer. And that's really what's going on. And I think as this progresses, as the U.S. economy slows a little bit more, we're going to see more hours cut back. Slowly but surely, we'll see new job growth slow as that gets more pronounced. And then it's going to start to show up in the data. And one of the places it's likely to show up is in auto sales. It's a big ticket item. And we can see auto sales have been hovering for about the last 3 to 4 years, just under the 17 million mark. So just like any stock, if support was 16.8, $16.80 compared to 16.8 million shares, if it drops below that, that'll be a warning sign, I think, that we are seeing consumers start to pull back. And quite honestly, this is what I expect to happen. ISM Manufacturing Index. If auto sales slow, it's going to feed directly into ISM Manufacturing. So sometime in the not too distant future, we're going to see the ISM figure drop from 51.2 to something under 50. These are all signs that I think are coming based on the internal weakness that was in the job report that the majority of analysts, I think, probably overlooked. Thanks again for tuning in. May something good happen to you today.